Hey, good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Omicron emerges. We have been writing to clients that we did feel that the virus would certainly be a part of the dialogue and narrative heading into 2022, although we know we're in a much, much different and better place. Dissemination of information, the reaction function. We talk about reaction function on the part of monetary authorities, but what about the reaction function in terms of governmental officials, which in these instances seem much more relevant in terms of what we're seeing short term, in terms of lockdowns, restrictions around global travel. So here we go again, but even more so, we've been talking to clients about the differential and volatility indices between rates, that volatility, the extreme volatility that we've seen since September of 2021, and the lack of spillover into equities and credit, call it the VIX, call it the CDS investment grade index, which both now have spiked dramatically within a short period of time, although alleviating and coming back down this morning. So it always takes a catalyst. Clearly, in this case, it wasn't interest rates per se, but there was a catalyst to bring markets off of extreme levels. You look at the time of year, you look at liquidity issues, which have already been prevalent in the U.S. Treasury market, certainly on Friday. Today, markets trying to claw back a little bit. But the reality is, even when you look at equities, if you look at the moving averages of, say, the S&P 50-day, 100-day, there's still another 3 to 5% of downside here before markets would be challenging any premise that this is part of something bigger. Now, we're not advocating adding to risk here at this time in the year, and we certainly think going forward, risk assets will likely be more challenged. We're going to see a decreasing influence on the fiscal side. And certainly on the monetary side, central banks have shifted course here. So this notion, a lot of talk this morning about the Fed put. I mean, the reality is right now, what has changed for monetary authorities and central banks, what's changed is very, very obvious. We see the inflationary numbers out of Germany this morning. We see what's going on here in the United States. Central banks, the Fed included, cannot afford to let inflation run the way it's been running, certainly with the risk of unanchored inflationary expectations. We certainly heard a spirit of that in the FOMC minute. So inflation will keep the Fed on their toes. The dialogue and the narrative hasn't changed. It's about the speed of the taper and certainly rate hikes. But short term, and it certainly fits our view, this notion of less, not more, in terms of rate hikes from the Fed. We think the Fed will be likely very protective of zero interest rate policy heading into 2022. So 3 hikes going down to 2 seems much more reasonable to us. Atlanta Fed President Bostic on Friday certainly saying we acknowledge the new variant, but he still sees or favors a faster taper, and in conjunction with that, 2 rate increases in 2022. Anything above that 3 and potentially more within a short period of time to us seems a little excessive. Now, again, the catalyst here is obviously the new Delta variant. With regard to the taper, we're going to be watching the data very closely. This week, we get a slew of data, including the ISM numbers. We also get a ton of Fed speak, including Powell himself, Clarida, Vice Chair Quarles, certainly on his way out, his parting words per se. Bostic and Williams will all speak. And the data, ISM, we'll be watching the feedback and the notes from both manufacturing and services around supply chains and certainly around labor issues. We get the employment number on Friday, which we expect another strong employment print here. We know jobs are plentiful, so we'll be watching labor force participation rates to see who, in fact, is, if any, coming back into the labor force to change that number, what the unemployment rate does, obviously. And then going forward, heading into the Fed's blackout period, the mid-December meeting, we'll get another CPI reading on the 10th. The market will be watching that very closely. And then obviously the Fed meeting on the 15th. Wishing everyone a great and successful week. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities.